Now to the results from CNBC's quarterly Delivering Alpha stock survey. 64% of the market participants surveyed said they would prefer to buy cybersecurity-related stocks over AI, weight loss drugs, or crypto mining stocks. Joining us right now on his expectations for the markets in 25, Kevin Gordon. He's a Charles Schwab senior investment strategist. Good morning to you.
Good morning. Happy holidays.
You like AI? Would you go AI over weight loss drugs, or how would you spin this?
I think from an AI perspective, and actually I think back to an outlook we wrote a year ago, my boss Lizanne and I, for this upcoming year. A lot of the focus actually from an AI standpoint was more so on the adopters versus the creators. Not that at the expense of one another, but one theme that we've been seeing, especially for a lot of industries that have been undergoing a lot of margin compression in particular over the past year, has been ways to alleviate the margin pressure. And a lot of that has been by, adopting some sort of AI to be able to plug into your model, whether it's for airlines that have traditionally struggled with margins, or even grocery retailers, which has been a really big theme, I think, and probably something that continues. Again, not at the expense of the creators. It's not that the tech world and all the chip stocks just take it on the chin because of that. But that's been a really big theme that we've been exploring over multiple years, not just in the near term.
Are you of the view that the Mag 7 continues, maybe the Mag 8 with Broadcom in it, or are you of the view that 2025 is not going to be friendly?
Well, I think from a weighting standpoint, yes, because it's really hard if you just take the size of those companies and to assume that they don't continue, even if they just grow at a modest rate. I mean, they're still going to have an outsized impact on the indexes. But there's often this conflating between performance and weight for the Mag 7. I find it really interesting that even if you just look year to date, and this is just looking at performance, I'm not an individual company analyst, but the second best performing stock in the S&P 500 is NVIDIA. If you look down the spectrum into the 200 ranking, the 207th best performing stock is Microsoft. So there are hundreds of companies that are outperforming one of the biggest tech companies, one of the biggest companies that we have in the S&P. So there's often, I think, this conflating where just because they're the largest, they're the best performers. Clearly, that's been the case for the group as a whole over the past month and a half since the election, but it's not always the case that they're going to be the best.
What does Fast Money have to say about this?
Well, I was curious about the AI beneficiaries, because that, in theory, should be the next leg of it, but we haven't seen that as an investable thesis yet.
Yeah.
So in 2025, you mentioned grocery store chains. I mean, all these places that could really benefit, their margins could benefit. Will that benefit the stock? Can you say, I'm going to invest in the users of AI?
Yeah. I think if you look at groceries in particular, it's part of the Staples Group, which has been sort of this material underperformer, in the past year and a half. And I think it's interesting because the concept of defense and what's considered defensive in the market has changed a little bit for investors. I think especially in this post-pandemic era, there are these times, especially this year in the first half of the year, where it was sort of the bias to move into the Mag 7 or Mag 7 type parts of the market for defense, not necessarily staples or healthcare or even utilities. Utilities is a little bit of a different story this year because there probably is more of an AI energy play there. But that, I think, is going to be a really important differentiator moving forward, especially for an area like staples. I don't think it's, don't approach it from an AI perspective from the standpoint of they're going to outperform materially. I think it's just being able to sort of maintain some sort of, mediocre level of performance, especially when you do go through downturns and you want to look at staples or utilities or healthcare as a potential hedge.
That's not a big selling point. You want to look for mediocre returns there.
It's
but
tough,
you think that the defensive nature of a Staples, for instance, that will be maintained? How about healthcare, which is done miserably, and the sentiment around that sector is horrible?
I know it's one of those you never want to be contrarian just for the sake of being a contrarian. But I mean, you look at some of the charts, especially relative to the S&P. You're looking at levels that are close to 07, 08, in terms of relative performance. I think healthcare is a tough one because it's such a wide range of industries that you've got there. One that I focus on a lot from a volatility perspective is biotech. I mean, you get these massive swings, especially in a higher interest rate environment where those companies tend to suffer more, not just from the level of rates, but just the volatility as well. It's a little bit tough. So I think that if you're looking at healthcare overall, you probably don't get as much meaningful upside because sometimes those names hold you back in times when there are drawdowns. But I do think that, if you're looking maybe industry by industry, there are definitely opportunities there, but it's not going to be as beneficial from the sector as a whole.